Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited to discuss 2025 Ultimate Bitcoin Roth IRA Strategy, how to contribute $70,000 to Fidelity Crypto Roth IRA. If you're on our YouTube channel, please subscribe so you get notifications of when we go live. We go live twice per day. Once at 10 a.m. Pacific, 1 p.m. Eastern. Then we're back again at 1 p.m. Pacific, 4 p.m. Eastern for the afternoon session. You can also subscribe or follow us on LinkedIn and the X channel so that you get notifications there. If you can come, you can hear what we want to present, as well as ask questions or topics that you want to go over. So if you do have questions or topics to go over, please chat those over. We always appreciate the chance to discuss. So again, please chat over questions or topics. Dive into the topic today, though, which again is 2025 Ultimate Bitcoin Roth IRA Strategy, how to contribute $70,000 to Fidelity Crypto Roth IRA. So the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So we first want to go over the details of Fidelity's new crypto IRA product, which they launched in April of 2025, which allows for direct cryptocurrency investments. So this is going to be different types of IRAs. They are offering traditional, Roth, and rollover IRAs that allow for investing directly in cryptocurrencies, including Bitcoin, Ethereum, and Litecoin. Fidelity's eligibility requirements provide that you need to be a U.S. citizen, age 18 or older. They do have certain state residence requirements. When we last checked, this was available in 38 states, but there are certain states, including California, where it's not yet available. I know they're stating that they're working to add more states. Fidelity does not charge any fees to open or maintain their crypto IRA accounts. Instead, they charge a 1% spread on all transactions. The cryptocurrency is stored at Fidelity, so there's no private wallet storage. It's per their website. It's stored in cold storage provided by Fidelity Digital Assets. And we'll talk more about the funding, but to preview it, you can only fund these crypto IRA accounts at Fidelity with cash, with fiat, via a transfer from another IRA, the same type of IRA at Fidelity, specifically a brokerage IRA. So for example, if you want to fund a Roth IRA at Fidelity to invest directly in cryptocurrency, you would need to fund it with cash by transferring cash over from another Roth IRA brokerage account at Fidelity. Now, there are some high-level considerations for solo 401k account holders that we want to just flag before we specifically go over how to contribute $70,000 where it ends up in a Fidelity Crypto Roth IRA. So if you're transferring money from your solo 401k with the intention to have it end up in a crypto IRA at Fidelity, that means you're transferring funds out of your solo 401k. So generally speaking, when you're transferring funds out of a solo 401k, you need to meet a triggering event. So you always have to consider the distribution rules, the rollover rules. And generally speaking, one cannot transfer funds out of a solo 401k until you meet a triggering event, such as being age 59 and a half or older. But there are exceptions. For example, money that's rolled into the plan can be rolled out at any time, as well as voluntary after-tax solo 401k funds. There's no triggering event that applies to either of those types of funds, so they can be transferred out of the plan even if you otherwise do not meet a triggering event. So that brings us to the mega backdoor Roth solo 401k. So one of the top reasons that customers sign up with us is the ability to make mega backdoor Roth solo 401k contributions. So when one makes a mega backdoor Roth solo 401k contribution, you're really making what's called a voluntary after-tax solo 401k contribution. And as we just mentioned, you can transfer voluntary after-tax solo 401k funds out of the solo 401k, for example, to a Roth IRA without needing to meet a triggering event. So for example, one could make a voluntary after-tax solo 401k contribution to the solo 401k and then transfer those funds out of the solo 401k to a Roth IRA at Fidelity, and then move the cash from the Roth IRA at Fidelity to a Fidelity crypto Roth IRA to make direct investments in cryptocurrency. So this has to be a cash transfer, no in-kind transfer. As we mentioned, there are state limitations. For example, California is one of the states where Fidelity is not currently offering their crypto IRA product. Finally, again, storage is going to be on Fidelity, no personal crypto wallet storage of cryptocurrency that's invested through your Fidelity crypto Roth IRA. So to continue to explain, let's take a step back and talk about the mega backdoor Roth solo 401k. So with the mega backdoor Roth solo 401k, the primary benefit is the ability to make contributions where those contributions end up in a Roth account. And because the contribution limits that apply to a solo 401k are much higher than an IRA, it's possible to contribute a much higher amount where the funds will end up in a Roth account. For example, for 2025, you can go all the way up to the overall limit, which is now $70,000 or even higher if you're age 50 or older. And like any Roth account, making a mega backdoor Roth solo 401k contribution has the potential for tax-free growth. So in order to be able to make mega backdoor Roth solo 401k contributions, you first, of course, need to be eligible to set up a solo 401k. So you have to be self-employed with no full-time, non-owner, non-spouse, W-2 employees working for any business owned by such person or a spouse, if any. One would then need to find a solo 401k provider like us, like My Solo 401k Financial, that offers a plan that allows for voluntary after-tax contributions and then in-service distributions. Because remember, on the last slide, you first make the after-tax solo 401k contribution to the after-tax solo 401k account, and then transfer the cash out to a Roth IRA, specifically to a Roth IRA at Fidelity, so a brokerage account at Fidelity for a Roth IRA. And then from there, transfer the cash from the Roth IRA at Fidelity to the crypto Roth IRA to be able to make direct cryptocurrency investments. So you want to work with a provider that has deep experience like we do in helping clients with all the technical requirements. For example, when you make those voluntary after-tax contributions, they need to be deposited into a separate voluntary after-tax account before they're transferred out to a Roth IRA. Moreover, while the voluntary after-tax contribution itself is not reportable on the personal or business tax return, the subsequent transfer from the after-tax solo 401k account to the Roth IRA is reportable on a Form 1099-R. And we handle that as an optional free service for our customers. In other words, no additional charge. Customers just have to let us know so we can capture the information that we need to prepare the 1099-R. We have an online form where customers can submit that information. As long as they submit it in a timely fashion, we'll prepare it as part of our service for no additional charge. So to continue to lay the foundation and the understanding of how one is able to contribute $70,000 to a Fidelity crypto Roth IRA, we want to go through an example. So let's first understand the voluntary after-tax contribution limits. So the voluntary after-tax contribution limit is 100% of self-employment compensation, dollar for dollar, up to the overall limit. For example, $69,000 for 2024, $70,000 for 2025. Now, one still needs to consider the overall limit. In other words, all the contributions that one makes to the solo 401k, whether employee, employer, and or voluntary after tax cannot exceed the lesser of self-employment compensation or the overall limit. It's also noteworthy that the voluntary after tax contribution limit does not go up if you're age 50 or older. So while of course our plan does allow for making catch-up contributions, in other words, those additional contributions that one can make if you're age 50 or older, those catch-up contributions are not made as after-tax contributions. Instead, they need to be made directly to either the pre-tax solo 401k account or the Roth solo 401k account. A couple of other important notes are that one's ability to make voluntary after-tax solo 401k contributions is not impacted by contributions made to another plan, like a day job plan. So another plan sponsored by an unrelated employer, like your day job 401k employer. Now, one exception to that general rule that the ability to make voluntary after-tax contributions is not impacted by contributions made to another plan through an unrelated employer is the 403b exception. So all contributions made to a 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. And then lastly, it's noteworthy that if you're making voluntary after-tax contributions, they need to be deposited into a separate voluntary after-tax account. This is why you'll see individuals that have 3 different accounts for their one solo 401k plan, because they have pre-tax funds, Roth funds, and voluntary after-tax funds. So you need to have separate sub-accounts for each type of contribution. So now let's apply these rules to a scenario. So we've got a baseline scenario where we have a self-employed business taxed, let's say, as an S corp, where it's one participant who's under age 50. And let's assume this individual has a day job 401k plan to which they also make contributions. And let's assume that they've made the maximum contribution, the maximum employee contribution to their day job plan. And their goal is to be able to make Roth or voluntary after-tax contributions, and they have $100,000 of W-2 wages from their self-employed business. So in that scenario, this individual is not going to be eligible to make employee contributions to the solo 401k because they already maxed out contributions to the other plan, their day job 401k plan. They're not interested in making pre-tax contributions. Remember, their goal is only making Roth or voluntary after-tax, but they can contribute 100% of their self-employment compensation, which in this case is their W-2 wages from the self-employed business tax as an S corp. They can contribute 100% of that self-employment compensation, those W-2 wages, dollar for dollar, up to the overall limit. For example, $70,000 for 2025. And then because there's no restriction on the ability to transfer those voluntary after-tax solo 401k funds out of the solo 401k to a Roth IRA, they could then transfer the $70,000 out of the voluntary after-tax solo 401k account to a Roth IRA at Fidelity, to a brokerage account at Fidelity. Now that transfer is going to be reportable, right? Even though the first step, the contribution, is not reportable on the personal or business tax return, the second step, the transfer from the after-tax solo 401k to the Roth IRA, is reportable on a Form 1099-R. And again, we handle that as an optional free service for our customers. So now this person has $70,000 in their Roth IRA at Fidelity. They could then transfer the $70,000 from their Roth IRA at Fidelity to this new crypto Roth IRA at Fidelity to invest directly in Bitcoin or the other cryptocurrencies that are available on the Fidelity platform. So here again, we've got the steps, right? Step 1, you make the voluntary after-tax contribution. Step 2, you transfer to the Roth IRA at Fidelity. Step 3, you let us know about the transfer so we can capture the information that's needed to prepare the 1099-R. Now, there is a deadline to make the contribution. You have to make that contribution by your business tax return deadline, including any timely filed extension, but there's no deadline to transfer from the voluntary after-tax account to the Roth IRA. Now, again, it's going to be reportable on a 1099-R, but it's going to be reportable for the year of the transfer. So, for example, we have many customers who are making 2024 contributions now, here in 2025, by their business tax return deadline, including extension for 2024, here in 2025. So that necessarily means that the funds are not going to be transferred from the after-tax solo 401k account to the Roth IRA until 2025. So that means that the 1099-R will be issued for 2025 by the beginning of 2026, by February of 2026. Here's a good visual as it shows the different accounts, right? So this individual has an after-tax account for their solo 401k, and then they transfer the cash out of the after-tax solo 401k to a Roth IRA at Fidelity. All right, well, that takes us to the end of the questions that we wanted to share. Thank you so much for participating. If you found this helpful, please like the video, whether you're on LinkedIn or YouTube or X, as that helps us to get the word out to other solopreneurs like you. There's a growing number of self-employed individuals who this information could be super valuable to. So just by liking, you can help to get the word out to other self-employed individuals just like you. So we really appreciate that. Or share it with others that might find it helpful. Please subscribe on our channels, whether on LinkedIn or YouTube or X, so you'll get notifications of when we go live and you can come and ask questions. All right, so the best way to learn is to come to these webinars, ask questions, just hear what we wanted to bring and share. Also, our website has a wealth of information. Let me grab a good launching pad on the website to learn. Thank you so much. We appreciate it. There's a good page to start with. All right, we'll be back tomorrow with more content. We appreciate the participation today. And until next time, again, please continue to participate. Thank you so much.